Trading myths persist because they sit at the intersection of human psychology and the desire for simplicity in a complex environment. At their core, these myths are not completely fabricated. They often contain a fragment of truth, but they are presented in a way that makes them seem universally applicable. This is what makes them dangerous. They sound logical, they are easy to remember, and they offer a sense of clarity in a field that is otherwise uncertain and difficult to master. Over time, repeated exposure to these ideas gives them an illusion of reliability, even when real-world results fail to consistently support them. One of the strongest forces behind the persistence of trading myths is confirmation bias. Traders naturally seek information that validates what they already believe, while dismissing or overlooking evidence that contradicts it. For example, if a trader believes that a certain indicator is highly effective, they will remember the trades where it worked and ignore the ones where it failed. Even a small number of successful outcomes can reinforce the belief that the strategy is reliable. This selective perception creates a distorted view of reality, where the strategy appears more effective than it actually is. Over time, this bias strengthens confidence in ideas that may not hold up under consistent testing. Another key factor is the way trading education is often simplified. In order to make complex concepts easier to understand, many ideas are reduced to short, memorable phrases or rules. While this approach can be helpful for beginners, it often removes the nuance that is essential for real-world application. Statements like, "The trend is your friend," or "more indicators increase accuracy," sound practical, but they lack context. They do not explain when these ideas work, when they fail, or how they should be adapted to different market conditions. As a result, traders adopt these concepts as absolute truths rather than conditional guidelines. This oversimplification leads to misunderstandings that can negatively impact decision-making. Social reinforcement further amplifies the problem. When a belief is widely shared within the trading community, it gains credibility simply because of its popularity. Traders see the same ideas repeated in videos, forums, and discussions, which creates a sense of collective agreement. Questioning these beliefs becomes more difficult, not because they are proven, but because they are socially accepted. This environment encourages conformity rather than critical thinking. Many traders adopt strategies or concepts not because they have personally tested them, but because they appear to be commonly used by others. An important aspect to understand is that most trading myths are not entirely false, they are incomplete. A concept may work under certain market conditions, but fail under others. For instance, a trend-following approach may perform well in strong, directional markets, but struggle in ranging or highly volatile environments. Without understanding these limitations, traders apply the same idea across all situations, expecting consistent results. When those results do not materialize, confusion and frustration follow. The issue is not necessarily the concept itself, but the lack of depth in understanding how and when it should be used. This is where testing becomes essential. The only reliable way to separate assumption from reality is through objective evaluation. By applying a strategy across a large number of trades and under consistent conditions, traders can begin to see its true performance. Testing removes emotional bias and replaces belief with evidence. It reveals not only whether a strategy works, but also the conditions in which it performs best and the risks involved. Without this process, traders are essentially relying on opinions rather than data. The key insight is that widely accepted ideas should never be assumed to be correct simply because they are popular or easy to understand. Trading requires a mindset that values evidence over assumption. Instead of asking, "Does this idea sound right?" the better question is, "Has this idea been proven to work consistently under real conditions?" This shift in thinking encourages deeper analysis and reduces reliance on misleading shortcuts. Ultimately, breaking free from trading myths requires a combination of awareness and discipline. Traders must be willing to question what they hear, test what they learn, and accept that simplicity can sometimes hide important complexity. By doing so, they move away from belief-based decision-making and toward a more structured, evidence-based approach. This transition is not always easy, but it is necessary for developing a realistic understanding of the market and achieving long-term consistency. Breaking down common trading myths is essential because many of them sound logical on the surface, yet quietly distort how traders make decisions. These beliefs often persist not because they are entirely wrong, but because they contain partial truths that are misunderstood or applied without context. By examining them closely, it becomes easier to replace assumption-based thinking with a more realistic and effective approach. One of the most widespread myths is that using more indicators leads to better accuracy. At first glance, this seems reasonable. More tools should mean more confirmation, and therefore better decisions. However, in practice, adding multiple indicators often creates more problems than it solves. Many indicators are derived from the same price data, which means they tend to provide similar or lagging information. When too many are applied, traders frequently encounter conflicting signals. One indicator may suggest buying, while another suggests selling. This creates hesitation, confusion, and delayed execution. Instead of improving accuracy, it reduces clarity. Effective trading is not about stacking indicators, but about understanding a clear and consistent framework for decision-making. Another common belief is that a high win rate guarantees profitability. This is one of the most misleading ideas in trading. While winning frequently can feel reassuring, it does not determine overall success on its own. What truly matters is the relationship between risk and reward. A strategy that wins 80% of the time may still lose money if the losses are significantly larger than the gains. For example, small consistent wins can be wiped out by a few large losses if risk is not controlled. On the other hand, a strategy with a lower win rate can still be profitable if the winning trades are significantly larger than the losing ones. This highlights an important shift in thinking. Profitability is not about how often you win, but about how well you manage both wins and losses. The belief that markets can be predicted consistently is another deeply rooted misconception. Many traders approach the market with the idea that they need to forecast exactly what will happen next. While patterns and structures do exist, markets are influenced by a wide range of variables, many of which are unpredictable. Economic events, liquidity shifts, and collective behavior all play a role in price movement. Relying too heavily on prediction creates overconfidence, leading traders to take trades with more certainty than is justified. In contrast, successful trading is based on probability, not prediction. It is about identifying scenarios where the odds are favorable and managing risk accordingly, rather than trying to be right every time. Another myth that affects many traders is the idea that increasing trade frequency leads to higher profits. This belief often pushes traders into overtrading, where they feel the need to constantly be in the market. In reality, more trades do not necessarily mean better results. In fact, they often lead to the opposite. As trade frequency increases, the quality of setups easily decreases. Traders begin to take positions that do not fully meet their criteria simply to stay active. This increases exposure to unnecessary risk and reduces overall performance. High-quality trading is selective, not constant. It requires patience to wait for the right opportunities rather than reacting to every market movement. A particularly harmful misconception is the belief that losses can be completely avoided with the right strategy. This idea creates unrealistic expectations and leads traders to constantly search for a perfect system. The truth is that losses are an unavoidable part of trading. Even the most effective strategies experience losing trades. Attempting to eliminate losses often results in poor decisions, such as moving stop-loss levels, holding on to losing positions for too long, or avoiding valid trades out of fear. These behaviors tend to increase losses rather than prevent them. Accepting losses as a normal part of the process allows traders to manage them more effectively and maintain consistency. What all these myths have in common is that they simplify complex realities. They take one aspect of trading and present it as a complete solution, ignoring the broader context. This is why they can appear convincing at first, but fail over time. Recognizing their limitations is a crucial step toward improvement. It encourages traders to think more critically, question assumptions, and rely on evidence rather than belief. Ultimately, moving beyond these myths requires a shift in mindset. Instead of looking for certainty, traders begin to accept uncertainty. Instead of chasing perfection, they focus on consistency. And instead of relying on popular ideas, they develop their own understanding through testing and experience. This transition does not just improve performance, it creates a more stable and disciplined approach to trading, where decisions are based on logic rather than illusion. Testing trading beliefs with data is the point where trading shifts from assumption to evidence. Many traders rely on ideas that feel right, but without structured testing, there is no way to know whether a strategy actually works or simply appears to work under limited conditions. Systematic testing provides clarity by replacing opinion with measurable results, allowing traders to make decisions based on reality rather than belief. The process begins with defining clear and precise rules. A strategy must specify exactly when to enter a trade, when to exit, and how much risk to take. Vague ideas such as enter on strong momentum or exit when the trend weakens are not sufficient because they can be interpreted differently each time. This inconsistency makes testing unreliable. Clear rules remove ambiguity and ensure that every trade is executed in the same way. Without this foundation, any results obtained from testing will lack meaning, because they are not based on a repeatable process. Once the rules are established, historical data becomes a powerful tool for evaluation. By applying this strategy to past market conditions, traders can simulate how it would have performed over time. This process, often referred to as backtesting, reveals important insights. It shows how the strategy behaves during different phases of the market, including periods of high volatility, strong trends, and consolidation. It also highlights strengths and weaknesses that may not be obvious in a small sample of trades. However, it is important to approach historical testing with caution. The goal is not to perfectly fit the strategy to past data, but to understand general behavior and performance patterns. Forward testing adds another layer of validation. While historical data shows how a strategy would have worked, forward testing shows how it performs in real-time or simulated live conditions. This is crucial because real-time trading introduces factors that historical testing cannot fully replicate, such as execution delays, emotional pressure, and changing market dynamics. Forward testing helps confirm whether the strategy remains consistent when applied in a live environment. It also allows traders to build confidence in their system before risking significant capital. Consistency throughout the testing process is essential. One of the most common mistakes traders make is changing variables midway through testing. Adjusting entry criteria, modifying stop-loss levels, or altering position sizing during the evaluation phase can distort the results. When conditions are not consistent, it becomes impossible to determine what is actually working. A valid test requires that the same rules be applied across all trades and scenarios. Only then can the results be considered reliable. Analyzing performance metrics objectively is another key component. No single metric tells the full story, so it is important to consider multiple factors. Win rate indicates how often trades are successful, but it must be evaluated alongside the risk-reward ratio to understand overall profitability. Drawdown measures the extent of losses during losing periods, providing insight into risk and sustainability. Overall profitability shows whether the strategy generates positive returns over time. Each of these metrics offers a different perspective, and together they create a more complete picture of performance. Focusing on just one metric can lead to misleading conclusions. It is also important to test strategies across different market conditions. Markets do not behave the same way at all times. There are periods of strong trends, periods of consolidation, and periods of unpredictable volatility. A strategy that performs well in one environment may struggle in another. For example, a trend-following strategy may generate consistent profits during trending markets but experience frequent losses during ranging conditions. By testing across various scenarios, traders can identify when a strategy is most effective and when it should be avoided or adjusted. Ultimately, the goal of testing is not to find a perfect strategy, because one does not exist. Instead, the objective is to develop a deep understanding of how a strategy behaves. This includes knowing its strengths, its limitations, and the conditions in which it performs best. With this understanding, traders can make informed decisions, set realistic expectations, and apply their strategies with greater confidence. When trading beliefs are tested systematically, myths begin to lose their influence. Decisions are no longer based on what sounds convincing, but on what has been proven through consistent evaluation. This shift transforms trading into a structured, evidence-based process where clarity replaces uncertainty and discipline replaces guesswork. Replacing trading myths with structured principles is where real transformation begins. Once beliefs have been tested and their limitations exposed, the next step is to build a framework that is grounded in evidence and consistency. Unlike myths, which rely on assumptions and generalizations, principles are practical, repeatable, and adaptable. They guide decision-making in a way that remains stable even as market conditions change. One of the most important principles is simplicity. In trading, complexity often creates the illusion of control, but in reality, it increases the likelihood of error. Strategies that rely on too many conditions, indicators, or exceptions become difficult to follow consistently. This leads to hesitation, second-guessing, and inconsistent execution. A simple strategy, on the other hand, is clear and easy to apply. It allows traders to focus on execution rather than interpretation. Simplicity does not mean lack of depth. It means removing unnecessary elements so that the core logic of the strategy can function effectively without confusion. Risk management is another foundational principle that replaces several common myths. Instead of focusing on how much can be gained from a trade, the priority shifts to how much can be lost. Controlling risk on each trade ensures that no single decision has the power to significantly damage the account. This creates stability, which is essential for long-term success. A trader with strong risk management can withstand losing streaks and continue operating, while one who ignores risk may experience rapid drawdowns even with a seemingly good strategy. Over time, consistent risk control matters far more than achieving a high win rate. Closely related to this is probability-based thinking. Trading is not about predicting exact outcomes. It is about operating within a system that has a statistical edge. Each trade is just one event in a larger sequence, and its individual result is less important than the overall performance across many trades. This mindset reduces emotional pressure and helps traders stay consistent. Instead of reacting to wins and losses, they focus on executing their strategy repeatedly under the same conditions. Over time, if the edge is valid, the results begin to reflect it. Selectivity is another principle that directly counters the myth that more activity leads to better results. Taking fewer, high-quality trades improves overall performance by reducing unnecessary exposure. Not every market movement is an opportunity, and recognizing this is a sign of maturity in trading. Patience becomes a competitive advantage. By waiting for setups that meet clear criteria, traders increase the probability of success while minimizing noise and randomness. This disciplined approach leads to more consistent outcomes compared to constant, reactive trading. Discipline ties all these principles together. Without discipline, even the best strategy will fail. It is not enough to know what to do. Execution must be consistent. This means following predefined rules regardless of recent outcomes. After a loss, there may be a temptation to adjust the strategy impulsively. After a win, there may be a tendency to become overconfident. Discipline prevents these reactions from influencing decisions. It ensures that actions remain aligned with the plan, creating stability over time. Consistency in behavior is what ultimately produces consistency in results. Adaptability is the final piece of the framework. While discipline requires sticking to a plan, adaptability ensures that the plan itself remains relevant. Markets evolve, and strategies that once performed well may become less effective under new conditions. However, adjustments should not be based on emotions or short-term outcomes. They should be driven by data and careful analysis. By periodically reviewing performance and identifying patterns, traders can make informed changes that improve their strategy without compromising its structure. Together, these principles form a practical and reliable approach to trading. Simplicity ensures clarity, risk management provides protection, probability-based thinking creates realistic expectations, selectivity improves trade quality, discipline maintains consistency, and adaptability keeps the strategy aligned with changing conditions. Unlike myths, which offer quick answers but lead to long-term confusion, these principles require effort and patience, but they deliver sustainable results. Ultimately, this shift replaces belief with understanding. Trading decisions are no longer based on what sounds convincing, but on what has been proven through structured thinking and consistent execution. This is what allows traders to move from uncertainty and inconsistency toward control, clarity, and long-term stability. Building a reliable trading approach in 2026 is not about discovering a secret strategy or predicting the market with precision. It is about integrating tested principles into a structured and repeatable system. After moving beyond myths and validating ideas through data, the final step is combining everything into a cohesive approach that aligns strategy, risk management, and execution. This integration is what transforms trading from a series of random decisions into a controlled and consistent process. A reliable approach always begins with a clearly defined strategy. This strategy must include specific and unambiguous criteria for identifying trading opportunities, entering positions, managing risk, and exiting trades. Vague concepts or loosely defined rules create inconsistency, which leads to unpredictable results. A strong strategy is built on tested concepts, not assumptions. It has been evaluated across different market conditions and has demonstrated a measurable edge over time. Importantly, the trader understands not only how the strategy works, but also when it is most effective and when it is likely to underperform. This clarity removes guesswork and creates confidence in execution. Risk management is the foundation that supports the entire system. Without it, even the best strategy can fail. Consistency in risk is essential. This means defining position sizes, stop-loss levels, and overall exposure before entering any trade and applying them uniformly. Each trade should carry a controlled and acceptable level of risk, ensuring that no single loss can significantly impact the trading account. This approach reduces variability in results and protects capital during periods of drawdown. Over time, consistent risk management creates stability, allowing the strategy's edge to play out across a series of trades, rather than being disrupted by a few uncontrolled losses. Execution is where theory meets reality, and it is often where most traders struggle. A reliable trading approach requires disciplined execution, meaning trades are taken only when all predefined criteria are met. There is no room for impulse, hesitation, or emotional decision-making. Deviations from the plan, such as entering early, skipping valid setups, or adjusting stop-loss levels without justification, must be minimized. Discipline ensures that the results reflect the strategy itself, rather than inconsistent behavior. It also reinforces confidence, as the trader knows that outcomes are based on a structured process rather than random actions. Monitoring performance is another critical component of a reliable approach. Trading should not be viewed as a series of isolated events, but as a continuous process that evolves over time. By tracking results consistently, traders can identify patterns in their performance. This includes recognizing strengths, such as setups that perform well, and weaknesses, such as recurring mistakes or unfavorable conditions. Performance tracking also helps distinguish between normal variance and actual issues within the strategy. Without this analysis, it becomes difficult to improve, as decisions are based on perception rather than data. Continuous learning plays a key role in maintaining long-term effectiveness. Markets are dynamic, influenced by changing economic conditions, participant behavior, and technological developments. A strategy that works well today may require adjustments in the future. However, these adjustments must be based on data and observation, not on emotional reactions to short-term results. Learning in trading is not about constantly changing strategies, but about refining and improving an existing system. This includes reviewing trades, studying market behavior, and staying aware of evolving conditions while maintaining the core structure of the approach. Technology can significantly enhance this process when used correctly. Modern tools for charting, backtesting, and trade execution allow traders to operate more efficiently and analyze data more effectively. Automation can help reduce human error and improve consistency, especially in areas like order execution and risk management. However, technology should support the trading system, not replace it. Relying entirely on tools without understanding the underlying logic can lead to dependency and poor decision-making. The trader must remain in control, using technology as an aid rather than a substitute for discipline and knowledge. A key aspect of building a reliable trading approach is maintaining a long-term perspective. Short-term results can be misleading, as they are often influenced by randomness. A few winning or losing trades do not define the effectiveness of a strategy. What matters is performance over a large sample size where the true edge becomes visible. By focusing on long-term outcomes, traders reduce emotional reactions and maintain consistency in their actions. This perspective reinforces patience and prevents impulsive changes based on temporary fluctuations. In the final perspective, it becomes clear why trading myths are so persistent. They offer simple explanations in a complex environment, making them appealing and easy to adopt. They are often reinforced by occasional success, which creates the illusion of reliability. However, without proper testing and understanding, these myths lead to inconsistent results and repeated mistakes. They encourage traders to focus on the wrong aspects of trading, such as prediction, frequency, or superficial indicators, rather than on structure and discipline. This roadmap highlights a different path, one based on objective evaluation, structured principles, and consistent execution. By replacing assumptions with data-driven insights, traders can build an approach that is both realistic and effective. The goal is not to eliminate uncertainty, because uncertainty is an inherent part of trading. Instead, the goal is to manage it in a controlled and systematic way. Through testing, analysis, and disciplined behavior, trading becomes less about guessing and more about executing a process with a statistical edge. Ultimately, the key principle remains simple but powerful: question assumptions, test ideas, and rely on evidence to guide decisions. This mindset is what separates consistent traders from those who remain stuck in cycles of confusion and inconsistency. When trading is approached with clarity, structure, and patience, it evolves from a frustrating experience into a methodical process of growth and improvement. Over time, this is what leads to stability, confidence, and sustainable success in the markets.